Hey guys, I'm Rob Tatro. Today we're talking about segregated funds, an insurance mutual fund product that's been sold a lot lately. We're going to learn about it and talk about it some more. Rob Tatro from robtatro.com, head of the Tatro Wealth Advisory Group here at Canaccord Genuity Wealth Management. If you want to learn more about this, if this is a topic that's on top of your mind, go to www.speaktorob.com. Happy to book a no obligation consultation for you where we can chat about this or anything else that's on your mind. So a segregated fund is typically sold by an advisor who's got a mutual fund dealer's license, or not even, perhaps sometimes they're only insurance licensed. It's an insurance product that's been created by the insurance companies, and there's a component of the product, component of the fund, that traditionally will guarantee either a 75% or 100% of the capital for the investors. Now, you know this, you've heard me say this in other videos, there is no free lunch. So you're paying for that guarantee. Like there's no debate, make no mistake, you're paying every single year a rather, some would say, large fee to make sure that you actually have that guarantee. Because it's an insurance product, the insurance companies actually will insure, or they'll self-insure the value of your fund or your portfolio, and they're charging you for that insurance component of the fund. So it's a traditional mutual fund. It'll show up on your statement. Usually you'll see, much like you would see a mutual fund code, you would see a segregated fund code. You would see it in the same way. Units, there's a value of each unit, there's a number of units. It's usually calculated to 5 or 6 decimals, and you own those units of the segregated fund. Now generally they have non-aggressive fund objectives, although you can find some that are kind of rather growth. The returns historically have been more modest, but generally they will have a guaranteed component to it. So to put that in perspective, you are investing in a mutual fund. You put $100,000 in one mutual fund. You will either have a 75% guarantee or a 100% guarantee. Now there's a whole bunch of variations to them that have come out in the last 5-10 years. Some will have a certain, they could be a rider on a specific portion of the assets that are guaranteed. But generally the base model, the base format is 75% of my money is guaranteed, or 100% of my money is guaranteed on my death or at a certain period of time in the future. Now, the devil's advocate would likely say, well, on my death, 75% guarantee of the 100 grand is not a really significant guarantee, because you would need a market crash or a market cycle that drops more than 25%, and you'd also need it to be a prolonged market crash or a market fluctuation, and you'd have to die in a period of time where the market has not come back. If you look at the historical data of the market using whatever benchmark you'd like, the Dow or the NASDAQ or the TSX, the S&P, there are very few times where that has happened over a prolonged time, and in fact, none if you look at like a 5 or a 10-year period of time, of those longer periods of time. And that's what we're thinking, that's what we're talking about when we're talking about guaranteed on death. Now the 100% guarantee is a little bit better, so this might be a product for someone who is fearful of the market and they want to know that their assets are guaranteed. Now to that I would say, well, you should have an advisor, and your advisor should be telling you how to build a portfolio that's more defensive, more protected, but for much cheaper. There are principal protected notes that exist. There are alternatives such as private debt that exist. There are many different ways to structure a portfolio to layer on guarantees, different types of guarantees that are much cheaper, and I would say much better than a segregated fund strategy. Now there's a limit. There's also an angle of creditor protection for these segregated funds. For some people that might be of interest, but generally it's not what you want. And they generally have a deferred sales charge as well. So that will mean a DSC. So you're selling this fund, and if you want to exit it, your liquidity is not guaranteed, or if it is guaranteed, there's a penalty to exit the markets. These things are not traded on the public markets. They're bought and sold end of day using net asset value, or we call a NAV on the funds. So you're buying it today, the value of these shares, it is $14.13725, and that's the value of the units, and that's your price if you buy or if you sell today. So they're a little convoluted and complicated. Generally, someone who is selling you this will be insurance licensed and will not have either an IROC license, or generally these are insurance products sold by insurance advisors. So be very careful, because it's not for everyone. The fees are really high. The performance historically has been worse because of the fees, and the guarantee is very, very, very seldom actually used because it's so far in advance. I'm Rob Tatro from robtatro.com. Guys, thanks for tuning in today. Love chatting with you about segregated funds. Give us a like, give us a follow, a share. I'd love to hear your comments with respect to segregated funds. Also, if you have further questions on this, you want to chat about whether or not this is right for your portfolio, or if this is, perhaps something that was sold to you as an investment vehicle that wasn't right for you, go to www.speaktorob.com. We'd love to book a no obligation consultation with you. Thanks so much, guys. I'm Rob Tatro. See you soon.